Good evening, everyone. I'm Angie Schick. I'm the program manager for the BCIC New Ventures competition. Thanks for joining us. If you're just coming in, we'll grab some extra chairs in a couple minutes. Hang tight. Slightly underestimated the turnout Mike Volker still gets. So thanks for squeezing in. For those in the competition, welcome. We had 168 entries this year, and it's going to be a good year. So any questions on that? I'm around all night. Otherwise, my only job here is to thank my sponsors, and then I'll pass you over to Mike. We'll do a 2-hour seminar. We'll take a break in the middle, and hopefully you're all at the door at around 9 o'clock. So our lead partner and title sponsor is the BC Innovation Council. Our gold sponsors are Ernst & Young, Fasken Martineau, Van City, Vancouver Economic Commission, and the BC Bioenergy Network. Silver sponsors are BCTIA, SFU BD School of Business, UBC Sauder School of Business, and Progressa. And our bronze sponsors are Acetech, Webnames.ca, VEF, Rocket Builders, Skyrocket, Spacecraft, Front Funder, and Pusher Media. And next week, we'll hopefully be able to announce one more silver sponsor for the life science sector, but fingers crossed. All right, so over to Mike Volker.
Okay, thanks, Angie.
Oh, actually, sorry.
Am I on?
One last thing.
Okay.
We are webcasting tonight, so if you have a question, please put up your hand. I'll run this microphone over so you can ask your question in the microphone, and people watching online can listen to it as well. Thank you.
Okay, great. Thanks, Angie. And thanks to all of you for coming out this evening. I hope I can impart some knowledge and give you a few ideas, something to work on. Just by way of quick background, so you know where I'm coming from, the slide says Innovation Office, Simon Fraser University. So I was running the Innovation Office for about 19 years, and then I retired last year. But while I was doing that, and before I was doing that, and for a long, long time, I've really been an active angel investor, someone who's built a successful company, sold it, and then has spent time and money investing and supporting new ventures. So my background, very similar to Ralph Turfus's, who you heard a couple of weeks ago, engineering student, University of Waterloo, created a company along with 3 classmates, 4 of us. It was a company that made video display terminals back in the 1970s, can you believe it? Even before these designs were developed by me and my friends as an engineering project before the days of the microprocessor. So these were random logic devices, clunky machines, the kind that you would see at airport terminals when you signed in and got your boarding pass. So we made these video display terminals, and it started as an engineering project, turned into a company, a fairly successful company. We sold these products globally all over the world, and sold the company about 8 or 9 years after we started it. Actually, we didn't really sell it. We merged with 7 other companies and created one very large company, and we took it public on the stock exchange and got a nice piece of change for doing that. And after having spent so many years in building that business and not seeing family and friends and so on, because you all know what it's like to be an entrepreneur, I decided that what I would do is invest in new startups, typically university spin-offs, tech companies, and that's really what I've been doing for the last 30-some years. And so I want to tell you a little bit about that experience and talk about tonight what is expected of you in the New Ventures competition, how you can maybe advance your case to help you perhaps win the competition, and perhaps even more importantly, to talk about the whole investment climate, especially here in British Columbia, because most of you will probably require capital to build your companies. That's not always true, and we'll have an example of that. In fact, to start things off, I've got a couple of prizes here I can hand out to people who get these answers right. But can you think of the company that had a phenomenal exit in the last 2 years, let's say, that really bootstrapped itself and didn't require a lot of capital? You got it. And tell us about Plenty of Fish. Yeah.
his own office, and he started with 500, I believe, and then he started
$500 million exit, right? And he never had any angel investors. Phenomenal story. Another success story, another one maybe not quite as spectacular, another one that, can you name one that went through the New Ventures competition that had a successful outcome?
Austin.
Not yet. It came through.
Recon Instruments.
Recon, yes. Recon sold to Intel for I think around 170 million, something like that. Yeah, it's a good story. Recon was angel backed and venture capital backed. So that's a good contrast between the two. Can you think of other BC success stories? Local entrepreneurs that made it big?
Vega.
Who?
Vega Nutrition.
That's a good one. Yeah, in the food products. Jim, you probably know about that one. Yeah. Any others? Foodie is hopefully. I'm an investor in Foodie. I hope it does well. That one too. I'm an investor in that one. I hope it does well. But they're not successes yet. Both of them are burning through lots of cash and plowing along. You know, so any others? See, that surprises me a little bit, you know, and that tells me that we have to do a better job of promoting the success stories, because success begets success. And if you see these stories, you'll say, hey, I can be just like that. And after you listen to me, you'll say, hey, shit, I can be like Mike Volker, because look at him, he's up there and he did okay, so if he can do it, I can do it, right? So that's what I hope you'll take away here. And when you look at the successful companies, you know, it's a combination of factors. It's a bit of luck, it's having the right product, it's having the right team, it's getting some backers. It's a whole bunch of different things. And we'll be touching on some of this stuff this evening. So we talked about local success stories. Now, one of the things I want to start off with is the E-Myth. There's a fellow business consultant by the name of Michael Gerber who has written a lot about this, and I found it actually very useful for me personally when I was building my business, because he was shedding some light on what it takes to really build a successful company and all of the pieces that go in there, all of the mechanical pieces that make a company work. And his basic thesis and where he was starting from was that entrepreneurs, or people that think they're entrepreneurs, are really not entrepreneurs. They are really technical people, technicians, suffering from an entrepreneurial seizure. And what he meant by that was that just because you're a good programmer or a good hairdresser or a good auto mechanic, that doesn't mean you can become another Apple or another Tesla or whatever. So it takes a lot more than just your technical skill to deploy that and make money in the marketplace. And this observation is painstakingly clear, especially to angel investors who back entrepreneurs that have very, very little business experience. There's no substitute for experience. And when you look at angel investors who take a gamble on companies like yours, I compare it to going in for open heart surgery. And if you're lying there on the operating table and a rookie comes out and says, hey, I just graduated from UBC and you're my first open heart surgery patient, it would make you a little bit nervous, right? You'd feel a little more comfortable if a guy walked in maybe in his 40s or 50s and said, boy, you know, I've done thousands of these and not one of them has died on me, so, and you're next. That would give you a little bit of confidence and make you feel good. But investing in startups is a little bit like investing in that rookie. Never been there, never done that. And that's, and I'm going to talk a little bit about how you can deal with that, especially when you're talking to angel investors. I think in my humble opinion, there are really basically just two success factors or two things that contribute to success. It's you, first of all, and it's your experience, your willingness to take risk, and most important of all is your total commitment to the business, having no distractions, being totally, absolutely, 200% committed to the business. And second, capital, having enough cash, even if you bootstrap, so that you don't run out of cash, because I've just seen too many really good companies fail because they lack cash. even profitable companies, and I'll give you an example of that, can fail because of cash flow issues. I want to share with you a few observations that I hope will encourage you in this competition and in pursuing your ideas. First of all, good companies will always get funded. You know, it distresses me when I pick up the Globe and Mail in the morning and they say, oh, you know, there's no venture capital around, they're all retreating and things are pretty dismal and there's just no money for good companies. I don't buy that. I have never ever seen any companies starve for capital if they have their act together. So we'll talk a bit about what that means. What is a good company? But I've never seen a company fail for a lack of investors. Startups like you guys are getting better each year. And we've seen in the new ventures competition that the quality of businesses each year has been improving. And in the particular cohort, like this year's group, I'm sure that many of you are far more sophisticated and knowledgeable about what you're doing than, say, companies in the same cohort a few years ago. There's a lot of private capital available, especially angel capital. Equity crowdfunding, you've probably heard of equity crowdfunding. It's coming. It's still in its early stages. But what equity crowdfunding does, we'll talk a bit more about it later, it has opened the door to a whole bunch of smaller angels, people who like to be angel investors but can't really afford to be angels, can now invest small amounts of money in your company. So instead of having 4 or 5 large angel investors, you will have maybe dozens or even hundreds of small investors, all nicely enabled through the internet. Venture capitalists, VCs, and this is something you should know because you really don't want to spend too much time too soon with venture capitalists. It's not a bad idea to start talking to them early to get them warmed up, but generally speaking, they invest much later. They don't invest at these really early startup stages. And when they do invest, they're looking for so-called unicorns, companies that are going to have exit values or enterprise values ultimately of around $1 billion or something in that range, which is very, very rare. So VCs invest in relatively few companies, whereas angels and private investors invest in many, many companies. The other observation, and this regrettably has not changed over the years, is that most companies do fail, and the success rates are unfortunately very low. So it's a challenge, and frankly, it's tough. It's tough to build a successful business. I don't think there's anything harder than building a viable, successful company. So now is a good time to start a company. And I say that because of, first of all, environmental factors. Prime rate interest rates are very, very low. That means that investors are keen to take a little bit more risk and invest in companies like yours. They don't want to put their money in the bank and get 2% or 1.5% when maybe they can get 20 or 25% on a regular basis by investing in ventures. Also, we have a low inflation environment, which is good economically. Here in British Columbia, we have pretty good tax rates, especially for small businesses. And for entrepreneurs, we have the lifetime capital gains exemption. So when you sell your company, you can take in over $800,000 in capital gains and pay no tax on that. And then everything above that is at half the normal rate, which is fabulous too. R&D costs, fantastic, especially here in Canada, and in BC even better than in the rest of Canada. We have the SRED tax credits, which can actually give you something in the neighborhood of 68 to 78 cents back on every dollar you spend on R&D. So if you hire a technician and you pay him $100,000, you get back close to $70,000 of that. And this is not something you have to compete for. It's not something that you have to fight for. It's something that you just simply fill out a form for when you file your tax return. and you get it as a check in the mail from Her Majesty the Queen. We have a great infrastructure here in British Columbia. There's many, many incubators, accelerators, angel networks, forums, workshops. It's a very rich, vibrant community. So I think you're all very, very lucky to be in a place like Vancouver and BC. There are some other special incentives. The biggest and the best one, and one that I'm sure that most of you who raise money will certainly take advantage of, is what the British Columbia government instituted almost 2 decades ago, and it's called the Small Business Venture Capital Act. And if I invest $100,000 in your company, the BC government will give me back 30% of that investment. So it'll give me back, and it does that through the tax system as a refundable tax credit, but it's effectively as good as a check. So I write you a check for 100, I get back 30. Pretty good deal. What that means is that I have 30 that I can put in another deal. And so that means that more capital is deployed in British Columbia companies. Last year, for example, angel investors put over $100 million into startups. And of course, for that, they get back 30 million. Without that, I don't think they would have invested 100 million. It probably would have been more like 50 or 60 million. So this is a program that's really working and one that you should definitely be aware of. Another reason it's good to start a company is because there's still a ton of uninvented things out there, right? There are more uninvented gadgets and ideas and things than there are invented gadgets. And besides, no matter what you come up with, I'm sure the Americans, someone there will buy it from you. Some of the innovation incentives, I should talk about this. Here's an interesting one. A gentleman over here mentioned General Fusion as one of the success stories. Here you see the founder on the right, Michel Laberge, who started General Fusion back around 2003, I think it was, about 2002, 2003. And he had this crazy idea to make a better world through creating clean energy using fusion. Not fission, but fusion, fairly safe, fairly clean. And the fuel for fusion is basically seawater. It's the deuterium that's found in seawater. And a gallon of seawater has about the energy efficiency of something like 500 gallons of gasoline. So it's a pretty compelling story. So he raised a few $100,000 from our angel network just before Christmas. I guess people were feeling, in the Christmas mood, so they were writing checks quite freely. And he raised $400,000. And the deal was that if his initial experiment didn't work, investors would get back all of their money. So how does that work? Well, very simple, through all of these tax breaks. So investors who invested in General Fusion got the 30% that I just referred to momentarily, a few moments ago. They also get back, if they put their shares into an RRSP, they get another roughly 44% in tax savings. And if the business fails, you can still claim the SRED expenditure and get back 68%, which can flow back to the investors. So if this business actually failed, if the initial experiments didn't work out, the early investors would get back all of the money that they put in, maybe even a little bit more. Crazy, but it's true. To date, that company has raised over 50 million and has some very serious rocket science going on in Burnaby. Talk a little bit about access to capital. A good place to start, of course, is with yourself, your own pocketbook. If you don't have one, get a few credit cards. It's not that hard to get 10 credit cards and put $5,000 or $10,000 on each credit card. Very easy to get. Cheap money compared to angel money, believe me. So if you can get maxed out on credit cards, they're so happy to give you these cards. I mean, they charge such usurious rates that It's no surprise they're willing to take some risk. And as I mentioned, venture capital isn't that great at this stage of your development, so don't spend too much time on that. It's good to know about it, and it's good to make some friends in that community, but your odds of accessing venture capital at this stage are very, very small. Then you have junior public markets, which were at one time very vibrant. I mean, this is what built the resource sector here in Vancouver many decades ago. Even the resource sector is now kind of in a bit of a downward trend. But a few tech companies went this route. However, the good news is that I think these junior markets are going to be eclipsed by crowdfunding. And I think crowdfunding will basically create a whole bunch of small junior exchanges through the internet and do kind of what the Vancouver Stock Exchange did for the mining sector several decades ago, and do that today for you guys. So crowdfunding, and by the way, just a quick mention on crowdfunding, there's several different types, but I'm talking here about equity crowdfunding, where you actually sell your shares to someone through a portal on the internet. And then angels, and the problem with angel investors is that they're a very, very small percentage of the population. The official, actually it's a legal definition, because you can't just stand up and say, I'm an angel investor. I mean, you can say that, but technically the government will not let you invest in a company unless you meet certain criteria. One of those criteria, and I'll touch more about it later, is that your income is at least $200,000 a year. The last Statistics Canada survey or report on tax filers in Canada showed, miraculously, that if you made $201,000 or more, funny number, 201,000, 201 or more, then you were in the top 1% of Canadian income tax filers. So that's a pretty solid number. Now the actual number is maybe closer to 4%. And the reason for that is that if you are wealthy, even though you may be earning a small amount each year, if you have more than $1 million of assets at your disposal, then you also qualify. And so there are many millionaires in Canada, and that bumps the number from 1% to 4%. Now that's not counting your residence, because in Vancouver, everyone would qualify. Right? So you have to take your house out of the equation and just count liquid assets, money in the bank, stocks, bonds, gold, that kind of thing. So it's a very small number, and that's a big challenge, because what you guys will have to do is try to find that roughly 4% of the population. And of course, those people are not all keen on technology, they're not all keen on entrepreneurship. So if you look at the percentage of that percentage of people who might be even willing to hear your story, it's well under 1%, maybe 0.2 to 0.3% of the whole population. So getting back to non-equity crowdfunding, watches like this, the Pebble watch, I was one of these 68,000 people that's referred to on the Kickstarter website. So I put my order in for 2 of these watches, $100 each, $200. I did it just to kind of see if it worked, if something would happen. Now, if the company failed to deliver the watch to me, which thankfully it didn't fail, but if it did fail, big deal. I'm out of pocket $200. But on the company's side, they raised over $10 million and didn't have to give up a single share of the company to do that. This is absolutely got to be the best way to raise money for your company. And it does a whole bunch of things in addition to giving you capital. It shows that there is a market for your product. It shows that people are willing to buy it. And you get a whole bunch of loyal supporters. So it's a fantastic way to raise capital without having to give up a piece of the action. So getting back to regulations, and you should know this. It's interesting. It always surprises me how many entrepreneurs don't know this. You can sell shares in your business to people that you know, obviously to yourself, mom and dad, uncles, friends, but not just any friend. It has to be a good friend or at least a person that you've known for 2 years. Or it could be a business associate, someone you've done business with for at least 2 years. But other than that, you are legally not allowed to sell your shares to anyone. And this is why crowdfunding is becoming such a popular movement, because it's going to kind of get around that restriction. And some of the securities regulators are already loosening up on their rules and regulations, and there are already viable crowdfunding platforms. I think there's a couple right here in town, as well as I think just about every province has one. There's it's Front Funder, right? You've heard of Front Funder. So there's Front Funder, there's Seed Ups in Calgary, and they have platforms where you can go post your business case and hopefully attract investors. But still the problem with crowdfunding is that you're going to end up with a whole bunch of investors. And what the government has done in its infinite wisdom to protect investors is to say, well, you can gamble, you can speculate on a startup, but we're going to limit you to maybe a couple $1,000s. That means that for you to raise a couple of million, you're going to have a few thousand investors. And that's, frankly, a bit of a pain in the neck. So although crowdfunding may work and may be good for you, it's probably still better to go with fewer investors that are willing to invest larger amounts. So the regulations say that the only way you can legally sell to someone without using a so-called prospectus, and a prospectus is like a very detailed, complicated business plan. So you have to do that and actually go public. So that's one way of doing it. But nobody does that because, especially at startup stages, it's just too expensive and prohibitive. So what the regulators have done is they've said, well, there are exemptions to doing a prospectus. We'll let you sell to certain people without having to produce this elaborate document. And one of those exemptions is the family, friends, and relatives one that I referred to. The other one is accredited investors, which is the formal term for angel investor. So if you sell to an accredited investor, you don't need anything. You can come to me, I can write you a check, and it's almost as simple as that. I don't need anything from you by way of a detailed plan, although certainly I'd like to have that. I always think, these, my humble opinion, again, is that these securities regulators are erring a little bit too much on the side of keeping investors protected and not doing enough for you entrepreneurs, because they're basically preventing investors from speculating and taking risks. And we think that that's good. We've seen in the US, people take big risks, and we should certainly have more of that in Canada. I always think that it would be good if the regulators turned over this whole business of policing companies and regulating share sales to the Lotteries Commission. So get away with the Securities Commission and turning it over to the Gambling Commission, because that's really what investors are doing, and that's what crowdfunding investors are doing. So if you just be honest with them and say, hey, forget the regulators, you're gambling, and we're going to be regulated by the Gambling Commission rather than by the Securities Commission. So now let's talk about what angels are all about. What's a business angel? Usually, it's 99 times out of 100, it's a successful entrepreneur. Someone like you who started a company, built it up, sold it for millions of dollars, and now has money and time to invest in other companies. And that involves, perhaps you could call it giving back, but it's a little bit more than that. They also serve the role of mentors and coaches, And here at the New Ventures BC competition, for example, we have lots of mentors and coaches and angel investors. At any of the social events that you'll attend as part of this program, you'll meet a lot of the people that I'm talking about, and it'll give you an opportunity to start making those connections. I know for me personally, and I told you earlier, that this business about the E-myth and the lack of business experience, I was in that position when I started my company, but I was lucky enough to get an angel investor that had a lot of business acumen, very experienced, especially in finance and negotiating, and I just learned so much from him. It was worth a lot more than the money he put into the company, and it was through his contribution that we became a successful company. I already mentioned the definition here of the formal definition for angel investor is an accredited investor, either someone who's a millionaire or who makes at least $200,000 a year. I want to talk a little bit about why angels invest, because if you believe one of my first slides where I said that 90% of the companies fail, why would angel investors want to take those kinds of risks? There's a fellow by the name of Rob Wiltbank at Willamette University in Oregon who is himself an angel investor and runs an angel fund, and for many, many decades, well, a couple of decades, not that many, he studied angel investing, and he looked at thousands of companies that were backed by angel investors. And this is what he found in his survey. And these numbers, I think, are very important for you to keep in mind, just the high-level numbers. So the first one at the top is the IRR, the internal rate of return across the board was 27%. And he got that 27% by taking those other two numbers, the fact that the average hold period of an investment was 3.5 years, and the multiple, the return on that investment, was 2.6 times. So if you get back 2.6 times your money in 3.5 years, that gives you an annual internal compounded growth rate of 27%. Now, there's a couple of flaws in this, in that, first of all, the average hold may be 3.5 years, but that includes these blue companies here, the failures. And as you can see here, out of the sample survey, more than 50% of the companies produced less than the initial investment back to the investors. And most of them failed within the first 2 years, because failures usually happen quickly. Successes take 8 to 10 years. These blue bars show the failure rates, and you can see that the percentage of companies that paid investors 30 times their money or more is only around 4%. 10 to 30% around 3%. You can see the numbers are very, very small. So what this means to angel investors is that they have to do a ton of deals. Friends of mine that have done 6 or 7 investments have unfortunately lost all of their money. It's just not enough to invest in a small number of companies. The other fact that Rob found was that out of all of these investors, 40% of them got zero back. 40%. And again, that's because they didn't invest in enough deals or in enough good deals. The exit values are those green bars, and they show you that there are relatively few companies that on average exit at much more than, say, $20 million. Now, I was just at a workshop in Seattle a couple of weeks ago, and Rob gave a couple of updates. Here's another very important set of numbers for you to keep in mind. And these are the sizes of the investment rounds at the seed stages, at what is probably your stage of fundraising. So this would be the first round of capital beyond, say, your own money and maybe mom and dad's money that they put into your business. What's interesting is that it jumped up quite a bit last year in 2015. These are North American numbers, but the National Angel Capital Organization of Canada reports very similar numbers for Canada, which shouldn't be too surprising, but thing to keep in mind is that the amounts are going up, and what's stable, though, is what's reported at the top. The amount of equity you give up is somewhere in the 20 to 30% range. I think in Canada it's probably closer to 30%. He's saying 20 to 25%. So what he's really saying is that when you're out raising capital, if you need $500,000, you're going to give up 20 to 25% of your company. If you're raising $1 million, you're going to give up 20 to 25%. If you're raising $3 million, you're going to give up 20 to 25%. Doesn't seem to matter. So forget fancy evaluations, discounted cash flow scenarios, patent portfolios, and all that nonsense. The market is driving this, not any kind of economic or financial analysis. And the reason for it, it's a very simple explanation. Can anyone guess on why that would be the case? Why would the percentage that you give up be the same regardless of how much money you're raising? I'm out of... Oh, no, I got one left.
And the multiple times return on the previous thing that you showed?
That's part of it. That's a good point. You're saying to get a multiple return. So if you're putting in $3 million, you're going to get 10 times $3 million back. Yeah. But there's another really simple, very basic reason for it. What are you doing when you bring in investors? What do you do when you get married? Your relationship, you got a partner, right? You're bringing in a partner, you're bringing in an investor. It's like a marriage. You're bringing in a partner. Actually, it's a bit polygamous because you're bringing in a bunch of them usually. But that's what you're doing, right? You're dividing the pie. You own everything 100%, and people coming in, especially when you're just getting going, they're going to say, well, we want a meaningful piece. We don't want little 1%, and we don't want 90% because then we own the company, not you. But we want a nice chunk of it, and a nice chunk happens to be around a quarter of the business, right? So you have to come to grips with that. And the reason it makes sense, you might say, well, then I should be asking $3 million instead of $500,000, right? Well, that may be difficult, but it's not impossible. If you're, for example, a biotech pharma type company, you may need that kind of capital to start. And you may be able to make a compelling pitch to angels where they will write you a check for $3 million. But you're still going to give up 25% of the company. But if you're developing a web app, something that runs on your smartphone, then probably you're not going to be able to get 2 or 3 million. The best you can do is maybe 850,000 or something in that range. But again, you're going to be giving up 20 to 25%. It's a market condition. It just happens to work that way. And the other thing I learned from Rob at that recent workshop was in terms of exit values. We hear of the 500 million Plenty of Fish exits, or the one that you mentioned, the Recon, over 100 million. Those are very exceptional. Every month, Google, Facebook, Microsoft, they buy companies for $20 to $30 million. They don't pay those exorbitant prices. We don't hear about them, but that's a reality. That's what they're raising. So you can see these are the values in millions of dollars, and only 15% of the exits are at values over $50 million. Why is this important to you? It's because you're going to try to convince me as an angel investor that I'm going to make 10 times my money. And I'm thinking, but wait a minute, only 15% get over 50 million. So if you're telling me that your valuation is, let's say, 5 million, I'm going to think, well, that means they got to sell for 50. What are the odds that they can achieve that? It starts to work against you. So the reason I'm telling you this is so that you can be realistic in your expectations and your negotiations with angel investors. So how do you engage with investors and angels? For me, it comes down to two things. You've got to make a compelling pitch, and it's got to be somewhat intriguing. We run these angel forums here, sometimes in this building, sometimes in the other one. Every month we have angel meetings. So we have entrepreneurs coming in and pitching to an audience of angel investors. And the idea of these is just matchmaking. It's not to come and immediately get checks from investors, although that's happened, but that's unusual. So the idea is just to get somebody interested in your deal and in you and your company enough so that they'll go to Starbucks and have a coffee with you and talk a little bit more about it. That's the only purpose of doing that initial pitch. But to get to first base, it has to be really compelling. You know, I hear 100, I'm hearing about 10 to 20 pitches a week. And, you know, how do I separate the ones that I want to go and have a coffee with from the ones that I want to ignore? Well, there's got to be something that really grabs me, something that's really unique about it, and it's got to be compelling enough and intrigue me enough that I want to have that follow-on meeting. So whatever that is. Now, in your workshop with Ralph Turfus, I remember I watched the video. There was some discussion about, you know, what are some of the key features or selling points of your products. So it may be that, for example. It may be, what is it that's really exceptional about your product? It just makes it stand above everything else. Or maybe it's you and your team. Maybe you've got just a really great track record. Maybe there's something that you've got. Maybe it's a very powerful patented idea that's compelling. It could be any one of those things, but it's got to be compelling in the eyes of the investor. So in terms of what angels are looking for, let's turn it around a little bit. Angels are doing this not just to be bored. They want to have a good time and have a little bit of fun. Certainly they want an interesting opportunity. I'm finding that a lot of angel investors are crossing disciplines. So a person that maybe made their money in infotech may be investing in biotech because it's something they want to learn about. They may not be investing a great amount, but small amounts because, you know, it's something new and evolving and something that they're not familiar with, so it's an educational experience. And this is really important, they really do want to work with entrepreneurs that will listen to them. A lot of entrepreneurs are, in angels' opinions, a bit headstrong. They think they know everything, and that's a red flag for angel investors. So having someone who is kind of keen to learn from the angel's experience, that's a strong point for angels. Angels like to use their resources, their contacts, their own networks, people that they know that can help you. Of course, they do want to get attractive returns. They're starting always typically around 10x. So the expectation of the typical angel is to get 10 times his or her money back in under, hopefully, 10 years. Hopefully a lot more than 10x. But that's kind of the going-in expectation. They're looking for a couple of important characteristics in you, the entrepreneur. Personal attributes like being really intense about your business, having a high degree of integrity, reliability, trust, and action, doing things immediately. Because when it comes right down to it, all you really have to worry about is competition. And if you don't get there first, someone will beat you. I once had, was doing a little blog, and I was asking entrepreneurs if they could think of what the opposite is of procrastinate. Can you think of any word that is the opposite of, pardon? Action, that's a very good one. And, pardon? Execution. I like those. Any other thoughts? So what was cute was this one fellow wrote back and he said, how about we make up a new word? Let's call it hodeiate, from the Latin, to do it today. You know, don't put off to tomorrow what you can do today. And I always like to tell the story of one of the people that sat in this room a few years ago, who was actually one of the New Ventures first prize winners. And she went home that night and she said, I couldn't get to sleep tonight because you said that I should be doing today something I could be doing tomorrow. And I stayed up all night working on my idea and my concept. And I think there's some, and I think it really helped her a lot because it got her to, to immediately think about not being beaten by somebody else. Never put off till tomorrow something that you can do today. And then as far as the company is concerned, I stole these from Milton Wong, who is unfortunately no longer with us, but he was a very, very active angel investor in Vancouver, invested in hundreds of companies. And he was awarded the Entrepreneur of the Year by Ernst & Young one year, and I was listening to his speech, and he said what he looks for in a company is that, just for him, it was the 3 Gs. What's good about it? What's great about it? How big is it going to get? And is it going to make money? The greed factor. And so he distilled it down to 3 very basic components. So what do you offer angels? Well, there's that 20 to 30% that we talked about. You're bringing them in as partners. You're making them co-owners of your company. And hopefully you're also going to use them as co-contributors to your company through, for example, participating on your board of directors. Or, maybe if not on the board of directors, because not every angel investor wants to be a board, and you as the entrepreneurs don't want a very big board. So you could have them as advisors or just simply coaches or mentors. And of course, they want an upside gain. I mentioned several times now the 10x in 5 to 10. And by the way, if you do the math on those numbers, 10x in 5 years works out to 58% return, which of course really beats that 27% IRR that Rob Wiltbank reported. Funny enough, if you do get 10x in 10 years, you just happen to get that 26, 27% return. But the problem with this is that if an angel investor gets 26%, i.e. 10x, on one deal, what about all the other deals? What about if this is the one winner out of 10 deals that he's invested in, the other 9 produce 0. So the overall return to the investor in that scenario is basically 0%. So they get back their capital, but they don't get any upside. So while this looks really good, it's only good if it's either one of a few deals or if several deals produce similar or better results. By the way, interrupt or ask questions anytime. I should have mentioned that at the outset. So if I'm saying something that you think is BS and you want to challenge me, or you've got something to contribute, just put up your hand and let's hear it. Great, here we go.
How many years of revenue would you say would be the baseline for valuation of a company?
None. You don't need any years of revenue, if I understand your question correctly.
No.
To get investors in.
No, not to get investors in, but in the exit strategy. So
depends on the business. Like some pharma companies may never have any revenue. They just may be building a great patent portfolio. So it really depends on the business. And each business has different metrics. So for example, a business that, Jim, the food business, one of our investments is in a company called Daya Foods. They make a vegan cheese. You might have even seen it. It's available in almost every grocery store in North America. That company is doing phenomenally well. We started it with very small investment, now running close to $80 million a year in revenue. And the multiple in that business happens to be somewhere between 2 and 3 times profitable revenue. So in that case, that business would be worth somewhere around $240, $250 million using that metric. So each industry sector, each type of business has those kinds of metrics associated with it. And they're not that difficult to obtain. Now, if you're in software, for example, there's a group in Seattle called the Quorum Group. And they publish quarterly reports giving you those kinds of numbers. So depending on whether you're software as a service, enterprise software, a social app, or whatever you happen to be, they can tell you exactly what you're worth based on your metrics. It could be a multiple of revenue, it could be some multiplier of number of users, it may be a bottom line multiple, but they can tell you exactly for your type of company what it would be worth. And they publish these very extensive surveys, and they do like hundreds and hundreds of deals and exits themselves each year. So they're very knowledgeable in that very confined software space. But there are equivalents to Quorum in other industry sectors. And it's not that difficult to get that kind of information. Term sheet. I'm not going to go into terms with you, but you should know that when you're talking to investors, you're going to put together a document called a term sheet. Sometimes you would present the term sheet. It's probably a good idea to do that. In other cases, the investors may give you the term sheet and say, here's what we're offering. And the term sheet spells out a whole bunch of things, like, for example, the valuation. But the valuation really comes down to the price per share and how much of the company you're giving up for the amount that you want. The legal compliance, you want to make sure that everything is kosher from a legal perspective. Rights, very important, rights. Investors will want certain rights. They may want participatory rights so that you can't go out and dilute them and sell shares to a whole bunch of people without giving them the right to participate. They may be so bold as to ask for across-the-board anti-dilutive rights. They may want board seats. They may require monthly reports. There's all kinds of things that they may ask you for. The opposite of that is restrictions. They may want certain rights, but they'll put restrictions on you. One of my favorite restrictions that I put on any company I invest in, I say, well, the owner's salary, the amount that you take out by way of monthly pay, is going to be limited to a certain number that we negotiate and agree to, because I don't want to hire you. My purpose of investing in your company is not to give you a job. It's for us together to seize an opportunity and make a lot of money together. But I don't want you working for me, so I don't want to give you a big paycheck. So that might be a restriction I put on you. I might put a restriction on you in terms of how much autonomy you have in making a spending decision. So I don't want you to go out and buy a Porsche without my approval, for example. I don't think I'd give you approval for something like that. But nonetheless, you know, you'd put restrictions like that into the term sheet. Another very important one is vesting. So suppose I and a bunch of angels put $500,000 into your company, and you decide that, yeah, Mike's right, we're really not entrepreneurs, we're technicians suffering from an entrepreneurial seizure, let's go work for TELUS and get a real job. Well, in that case, you quit, and the investors are left with owning 20 to 30% of the company. New guys that have quit, you know, maybe it's only 1 out of 3 or 2 out of 3 of you on the team that have quit, but there's a big block of stock that has really not been earned. These are shares that you got for the idea, for starting the company. We call that founder shares. And, you know, you may have paid either $0 for them, or maybe you paid $1 for all of them just to make it legal. But they're free shares and they're founder shares. So it's not fair for investors to put their money in, which is firm and solid and unquestionable, and then you say, okay, I'm going to build a successful company, and you bugger off in a month. It's just not fair, right? So we put in a vesting requirement that says, okay, if you take off and quit, you have to give back your shares to the company so that we can then use those shares basically to replace you with someone who's not a quitter. So vesting is very important, and you'll see that in just about every term sheet. And then following a term sheet, you will start to discuss something called a shareholders agreement. And I'm not going to go into shareholders agreement because they can be very complex, but it sort of determines how you, as the owners of the company, are going to run and manage the company from a high level. You're going to decide who gets on the board of directors, what decisions can be made. How do you buy and sell shares? Can you sell shares to anyone on the street if you're a shareholder, or do you have to offer them to other co-owners first? So all of these details go in a shareholders agreement. And if you're interested, I've got some samples on my website. But actually, it's more than samples. It's kind of a discussion which asks you questions of what you want to accomplish. Don't make the mistake of going to a friend or a lawyer and saying, give me a template. There's no such thing as a template shareholders agreement, because the shareholders agreement for a lifestyle business like a restaurant will be quite different from a growth technology company that wants to be like a Google. Completely different scenarios, completely different circumstances. So you don't want to just take any old shareholders agreement and modify it by putting your names on it and taking somebody else's names off it. Ask yourself some of the questions. I want to talk a little bit about some angel funds just before we take a quick break. One of the things, because of the problem I mentioned with angel investing, and the number, by the way, happens to be over 20%. To be assured as an angel investor that you will not lose all of your money, you should be in about 20 different deals, 20 different companies. So that's a lot of work. So depending on how much money you've got as an angel investor, you know, you decide, am I going to put $1 million aside, or 10 million, or 500,000? And by the way, we see all types, right? The nice thing about angel investors is they're all so different. They're all over the map. Some are small, some are large, some are easy to work with, some are difficult to work with, but you know, they're quite a diverse group. So whether you put aside 500,000 or 2 million, how do you deploy that in 20 companies? That can be a real challenge. So because of that, what we're seeing is the emergence of angel funds, where 20 or 30 or so angels will pool their capital, and then kind of like an investment club, they will together decide to invest. And instead of investing just, you know, $50,000, they may write much bigger checks, but it would come from a fund rather than from them individually. It's interesting because I'm a member of the Bellingham Angel Group in Bellingham, and I was attending, when they first got going, I would attend these monthly meetings, and they had great presentations, compelling, intriguing, but nobody was writing any checks. And of course, nobody ever wants to go first either. But they weren't writing checks, so I asked them, I said, what's wrong with you guys? You know, why won't you write a check? These are good deals. They're great opportunities. Yeah, but if we write a check, we'll have one investment. You know, and I said, yeah. Well, why don't you write 2 or 3 checks? Yeah, but to get to 20, it's going to take a couple of years. And so they couldn't get started. So they were really blocked. It was this mental block thing, like writer's block. And so I said, well, throw your money into a kitty and then do 20 deals and do them fast. And that's exactly what they did. And they're actually making money through their angel fund. Locally, this is a fund that myself and a few angels started over 10 years ago. And we, like you, can give out tax credits to our investors. We've invested in over 60 companies to date, and about an average of $100,000 per company. And we may negotiate the term sheet, and then we'll bring other investors in to give you typically somewhere between 500,000 and $1 million. One of the problems that we're having, the big challenge right now, and I'll talk a little bit more about this, is getting out of deals. It's easy to get into a deal, but it's not so easy to get out of a deal.
Mike?
Yeah.
Is it possible for you to list one of your portfolio companies on a crowdfunding site?
We could list them all if they wanted to be listed on a crowdfunding site.
So
if I understand your question.
Whereby the investors are actually kind of buying a piece of what if, or somehow you are the front end for dealing with a large number of investors. The company just receives one check
Yeah.
from what if. Can
Yeah.
that work?
I'm still not sure I quite follow you, but I think if I understand you, it might work. But let's talk about it later, because I'm just a little fuzzy on what you're getting at.
I am too.
Yeah. Now, but the other way, like if people look at this portfolio of companies, like if, for example, that $80 million Daiya Foods vegan cheese company is in that portfolio. And so are a number of other companies. There's the Fusion company, there's Matza Innovation that Jim is a director of and that Ralph Turfus talked about the other day with you. It's in that portfolio. So if investors look at this portfolio and they say, hey, you got some nice companies in there, they can invest into that portfolio, right? But it doesn't go the other way. Those companies, if those companies need more capital, then we can introduce them to our investors for that capital. And if they wanted to, they could individually, of course, go on a crowdfunding site. But I doubt that they would. But they could. So where do you find angel networks and groups? You know, it's interesting. This is a global phenomenon. And angel investors are a global phenomenon. I just had a meeting with a young fellow who's working with entrepreneurs in Uganda and in Kenya. And I was in Kenya myself 4 or 5 years ago, and I met with dozens of entrepreneurs and angel investors. They're starting to crop up in even developing countries and underdeveloped countries. And of course, in fully developed countries, you know, Australia, United States, New Zealand, England, Europe, there are angel networks everywhere. So this is good news for entrepreneurs. And here in Vancouver, we're especially lucky to have a number of angel venues. We have our monthly Vantech meetings, which take place each month. And I would encourage you to come and make a pitch, even if you just do it for fun to see what kind of reaction you get. You're all preparing pitches for new ventures. So why not do a real world type presentation at one of our monthly Vantech meetings? We meet first Tuesday of every month. And then once you progress a little bit further, I'm also president of the K4, which is the Keiretsu Forum, which is a global angel network headquartered out of California, but with a big chapter in Seattle and a satellite here in Vancouver.
You spoke a bit about BC investors and the opportunities for them in terms of tax credits and stuff like that. Is there much more of a challenge in getting international investors to invest in terms of the
Yeah, definitely. Very good question. You know, if you haven't gotten any local investors, you probably won't get an it's highly unlikely to get an international investor. Because the international investor, the first question they will say is, well, who's invested locally? And because as part of their due diligence, they will want to talk to existing investors, probably. And if you say, well, I don't have any investors, you know, it would make them somewhat nervous or suspicious. Now, on the other hand, if you have a group of local investors, they can help connect you with investors in other parts of Canada. And globally too, for that matter. But speaking of Canada, the National Angel Capital Organization based in Toronto, one of its mandates is to try to do these national syndications. We're not there yet, but we're getting there. So we're now starting to see Vancouver companies raise money from Ontario or Manitoba and vice versa. That's starting to happen. But it's a bit of a slow process because I think angel investing is very much a contact sport. It's very much, you know, one-on-one, shaking hands, meeting over coffee, and that kind of thing. And that's one of the reasons why it's not just moving that quickly yet. But I think that'll change especially as investors get to know each other better across the country. On my website, you can download this book, because after all, the topic of tonight's presentation is making the business case. And I know Ralph got started on this with you, but this is a free download, and the reason I mention this and think it would be useful for you to take a look at it is because, as I mentioned to you, I hear lots and lots of pitches, and most of them I have no clue what the entrepreneur is talking about. Typical conversation, someone will phone me and say, hey Mike, I'm working on an enterprise application that'll make lives better for people in the Sudan, and we're better than best of breed and everything else and blah, blah, blah. I said, what the hell did he just say? I don't understand it. So what I want to know in very simple terms is who's going to buy whatever it is that you're selling. How will you make money? And this should look familiar to you. This is what Ralph went over, and I saw online that you were all working through some of this stuff, right? So I'm not going to spend any time on this, but again, I want to emphasize how important this is, how important it is to make your pitch in a very clear way to grab the investor's attention enough to have that follow-on meeting with you. And in addition to the elevator pitch, and this is something that Ralph didn't cover with you, you'd want to talk about the investor pitch. So you and your customers and how you're going to make money, that's great. But how am I, as the angel investor, going to make money? So what I want to know is how much money do you need? How much am I going to get? How much ownership am I going to get for it? And when and how am I going to get out? And that last sentence is probably the most important thing for you to tell a prospective angel investor. They want to have some idea as to how long their money is going to be tied up, how much they can expect to get paid out, and that can't be just a fantasy and a dream. It's got to be you doing some homework and saying, well, company X might buy us, and company X might buy us because blah, 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 and you have to make that case to the investors. So this is like an elevator pitch, but it's the second stage. It's the pitch to the investor, because the investor wants to make some money. So there is a little example for you to think about.
Isn't this a 10x return?
Pardon me?
Isn't this a 10x return?
Well, in this one, you're getting a 5x return in 5 years, which happens to be 38%. I'd rather have a 5x in 5 than a 10x in 10.
One more quick question.
You see, what's important here is the specificity. I'm mentioning names. I'm mentioning a company, Polycom in California, and the company name, and I'm mentioning dollar amounts and percentages, rather than just say, hey, investor, you're going to make a pile of dough. That's not good enough. Yes?
Yeah. At what stage an entrepreneur should go and reach angel investor? For example, he might have an idea on a paper and reach angel, or he should just invest some of his money, generate some revenue, and then approach an angel investor?
Yes. A good time to approach an angel is when you don't really need the money, because then you're not desperate and you're in a better negotiating position. So the earlier the better. I mean, if you know that you're going to need capital, if you're not going to bootstrap the business by growth internally or some sugar daddy relative or something like that, then if you know that you're going to need to raise money, the sooner the better. Get people to know you, because investment decisions aren't usually instantaneous. A good thing about angel investors is they will make quick decisions, sometimes the same day, sometimes a month later. But venture capitalists, on the other hand, typically take 6 to 9 months, right? So it takes much longer. But still, even with angel investors, the sooner you start, because then when you do need money and you know how much, and you can make this statement to them, it's going to make life much easier for you. Any questions on that? Any more? Yes, at the back there?
Are angels always looking for another company to buy the company to exit, or can they make revenue from the profits of the company itself?
The latter is very rare. Getting a payback. repeat the question? Yeah, do you want me to? I'll repeat the question. Yeah, so the question was, is it always through an acquisition that angel investors get their payout, or are there other ways, like, for example, by having a very profitable company? Out of the 100 and some companies that I've invested in personally, only one has ever given me money back out of profits. And it happened, funny enough, to be a non-tech company. It was more of a lifestyle business that just generated a huge amount of profit each year, but was limited in its growth. So I got back an annual dividend equal to the investment that I put in. So I got 100%. I put $50,000 into this company, and I got $50,000 a year out of it for 20 years. And at the end of that 20 years, they bought my shares for $500,000. So that was a good deal. But that's the only one. Now, most of them, very few of them, especially tech companies, are not in that position. And the reason for that is because they want to grow and grow and grow exponentially. So any money that they do make, any cash flow that's not going out to salaries and rent and so on, goes into new product development and R&D and those kinds of things to continue to grow, or marketing and sales, right? So you're never going to get paid out that way. So the only way really is when the company is acquired, or the other choice somewhere in between is to go public. So when you list on a stock exchange, now there's a market for the shares. So even though your company may be doing well, and this is the number one problem for angel investors, the number one challenge. Right now, I have a number of companies in my portfolio that are doing very, very well. They're very profitable, and they're on a roll. But do I see any of that money? No, I have to wait until they sell. Only then will I get a payout. I'll never get it from dividends. And there are companies that I've been in for more than 10 years, and I'm still waiting for that payout. And it's a long time coming. So one of the terms that angel investors are now putting into term sheets is forced exits. There are mechanisms that I won't elaborate on that will kind of force an exit. Because what's happening, a typical scenario, I'll call up Bob, who's running software SaaS company, and I'll say, hey, Bob, you know, I've been in this deal for 10 years, and you're profitable, you're growing each year. Sell the frickin' company so that I can go on a holiday. And they say, well, Mike, why should we do that? You know, our sales are doubling every 2 years. The Quorum Group in Seattle tells us that we're worth 5 times our recurring annual revenue. So cheapers, if we double, next year we'll be worth 10 times as much. So wait another year. Right? That's what I'm getting. So I wait another year. Next year, I go back. And in fact, they have doubled, or 2 years, they've doubled their sales. Then they say to me again, wait another year, because we're going to do it again. And it just never ends. Now, someday, they may crash, right? And they can crash because somebody comes along and beats them, competitor, right? That's what I worry about. So I say, sell before someone eats your lunch. And they say, no, wait, don't be greedy, just wait a little bit, let's get a little bit more. And that's a challenge. That's the number one issue in the whole angel community. So for you guys, it's really important, A, to understand that, and to figure out how to make it work for the angel investor. How can you look at them with a straight face and tell them they're going to get out in a certain period of time? Now, it's not important whether you say 5 years or 10 years. It's important that you say the number of years. Because some investors don't mind waiting 10 years. If they can see you become a unicorn or whatever, or a gazelle, and it takes 10 years to get there, they may be perfectly okay with that, right? But what I don't like is when someone says, hey, we're going to go public in 5 years, and you're going to get a nice multiple, and then 10 years later, they're still grinding away. That's what's disappointing. Now I'll leave you with one slide, and then we'll have a little break. So this is our Angels BS Bingo. And the way this works And this prevents you from BSing. This makes you put real numbers and real names and real facts into your pitch. Because if you say something, a long sentence that uses a lot of these phrases strung together, what we do, just for fun, we sit there, and when we hear one of those things, we exit out, right? And when someone can say bingo, then you have to sit down, and it's the end of your pitch. So keep this in mind, because, saying that you have a world-class product, well, that doesn't mean anything. Favorable valuation, what does that mean? You're going to go public on the NASDAQ? Yeah, everybody says that. Revenue traction, of course you're going to have revenue traction. Low burn rate, sure, music to my ears. Empowered team, everybody says this stuff. Doesn't mean anything. You can't put dollars on it, right? So go back to the stuff that you learned from Ralph and tell the investor that, and then you won't be forced to sit down. But now it's your turn to stand up, and let's take a short break. Okay. Boy, I've got another 2 hours of material for you. So let's get started. We'll cram it all into half an hour if we can. Someone was asking about, I mentioned the Quorum Group in Seattle, and if you want to Google it, it's spelled CORUM. And gentleman over by the pillar there was asking about other exit options for angel investors, in addition to a buyout or dividends or going public. There is, and someone during the discussion, during the break, pointed out there is another option, and it's starting to work, and in fact, Jim Pratt and I are involved with it. We've started a public company called Timaya Capital, which will invest in your company, but only when you start to generate revenue and profits. So if you're a startup, it wouldn't work. But once you get a few investors and now you, let's say, software as a service, and you start to generate revenue, what we would do is we would give you something between $500,000 and $2 million to take your sales from $2 or $3 million a year, to doubling it in every, say, 2 years. And we take no equity, we take no ownership in your company. So we negotiate with you a royalty percent on your top line revenue. And that could be anywhere from 2 to, let's say, 8 or 9%. So each month, every single month, you would send us a check. And when we get double, not 5x or 10x, when we get double our money back, that's it. We're done. You have no co-investor. We have no shares. And we don't have that pain of waiting 10 years or 15 years till you sell the business. So that's another option. And it's fairly new. I think in the case of the company that I just mentioned, Timaya, we're the only ones doing it so far in Canada with the tech industry. There's a group in Toronto that's doing it with all kinds of businesses, and there's a fairly big one in Seattle, also backed by a lot of angel investors, that's doing it big time. But we're going to see more of these kinds of creative funding mechanisms emerging because of this problem of this tension between, selling and not selling your company to get your investors out. So I just thought I'd mention that. But if you want to learn more about it, especially when you get to the stage of generating real revenue, we'd certainly love to talk to you. Now, let me talk a little bit about the competition, because after all, that's what New Ventures is all about. So I want to give you maybe a few tips and ideas here. So first of all, people usually say, is this a business plan competition? And I want to make it very clear, it's not a business plan competition. It's not one of these student type things where you put together, a 50-page document and you touch all of the bases and put all of the nice things that go into a business plan. It's a business competition. We would rather know more about the substance of your business than have you presented in a glossy, fancy sort of way. Although that can't hurt either, but it really comes down to what you're doing. So it's a bit of both. It's the business that really counts ultimately, but it's your plan, your documentation that explains it, hopefully in very clear terms so that the judges and subsequently angel investors will understand it. I should mention to you that in addition to prize money and getting good feedback, many, I don't know if we have numbers, Angie, of the companies that have come through the competition over the years that have actually gotten angel investment. But it's probably more than half. I would say easily more than half. Maybe 70, 60, 70% I would think have received, and not the winners necessarily. Funny enough, some of the losers have done very, very well, and I can think of, when I look at the list of winners, I can see a couple on there that have not done very well at all, so you never know. But the point is that it opens the door for you. So as far as the judges go, though, and I think this is probably true for angel investors as well, when they assess your opportunity, it's really what we say to them in their own, and they have to interpret this however they wish, is to pick the idea most likely to be commercially viable. So will it work? You know, will you actually start to generate some revenue and profit? But then ultimately create the largest value. So it's a bit of both, and in the opinion of the judges, and this is a difficult task for them, so the easier you make this for them, the better your odds are. In terms of scale, there's sometimes this thought that you know, these businesses all have to be unicorns and grow by leaps and bounds, but there's nothing wrong with having a goal of building a company that is going to, you know, get to 30 million of sales and grow 10 or 15% per year, employ 50 or 100 people, and be in a very specialized niche market and contribute economically. Absolutely nothing wrong with that. So what's important for you is to tell the judges what you want to do, not what you think that they want to hear, right? It would be a big mistake to think that they're only going to look at, you know, the shooting stars. They're going to put equal emphasis on good, solid companies that provide good economic benefits overall. So it's important for you to tell your story to the right audience. And by that I mean, if you're going to be a $30 million type of business, you're never going to talk to venture capitalists, maybe to angels and to others. And the job for you is to talk to enough people so that those that agree with your philosophy will buy in. And as I mentioned earlier, the really neat thing about angel investors is that they're so diverse. VCs, bankers, institutional investors, you can kind of, you know, categorize them and generalize and say, well, VCs will think like this and say this and that. But angels, it's not true. You can go to 10 angels and completely, you know, not score. And you go to another meeting with 5 angels, and maybe every one of the 5 will like what you're doing and be keen to talk to you. So it's very much a sales funnel type of thing where you just simply have to expose your idea to as many investors as you can. And if you're not getting any response at all, well, then you have to ask those investors why, and, you know, rework your pitch and your business plan. It all comes down to, you know, profit and loss ultimately. That's what's in a business plan. But for investors, it's also the other P&L. It's passion. You know, how passionate are you about the business? And your leadership. Do you have what it takes to lead a team to get those home runs? I gave you earlier the example of the guy that started General Fusion. You know, not at all a business guy. He was smart by recruiting good business people to join his team, but he was a scientist, a PhD in physics, who was so totally convinced that fusion will someday work, that when you talk to him, I guarantee he'll convince you that it'll work. And that's what I mean by the passion. And the leadership he brought in from business people that knew how to raise money and knew how to organize, buy buildings, buy equipment, and carry out the business plan. Now, just getting back to the competition, bear with me with some sort of basics here. So round one, you've already gone through that. That's your idea that you've submitted. The next round, and then the half round, the 2.5 round. It's funny why we do that, Angie, but we do. So that's the feasibility test. And that's due very soon, I guess, in a couple of weeks at 5 p.m., at which point we basically select 25 companies, sort of 15 and 10, but 25. And then there's round three, where we expect an even larger plan, but not a 50-page plan, just a little more detail. That's your venture plan, and that's due on August 3rd. So you have a bit of time between May and August. You have May, June, July, so what's that, 3-4 months to work on it. So I want to talk a little bit about the business plan. And, you know, it's kind of funny because what I'm showing in this picture is the banker that I dealt with in Waterloo, Ontario, when we started our video terminals company as engineering students. And, you know, I went into him. We got an order. We kind of bootstrapped the company. We did what I preached, i.e. we used bank loans, personal loans, credit cards, mom and dad, girlfriend. You know, my wife was at the time already working. I was still a student. She kind of funded my part of the deal. Anyway, we got a big order one day. This was 2 or 3 years after we were in the business. We were already making money and generating profit, but we got a really big order, and we needed cash to buy the inventory because we were, you know, putting together circuit boards and video displays, and we had to buy all of those parts. And those parts were pretty expensive, and we didn't have the cash to do it. So I went to the bank, and I said, well, you know, we've got a purchase order here. It's pretty obvious. We build the stuff, sell it, we get a check, pay you back, everybody's happy. And to my surprise, the banker says, show me your business plan. So, well, what do you need a business plan for? He said, well, I need to know what your projections are. I need to see from your business plan that you can actually pay me back the money that you're asking for. And it was only $50,000, but that was a long time ago. Anyway, I said, right, when would you like the business plan? He says, well, anytime, you know, come in next week. I said, right. I went back to the shop. I talked to my 3 founding partners. I said, hey, guys, do you know what a business plan is? The banker wants his business plan. I don't got a clue what that's all about. So we took a crash course, you know, with the business development bank was around in those days. It was called something different, but it was there. Took a couple of crash courses, worked on some numbers, put together a business plan. And funny thing is, went back to the bank, and he said, well, you know, you're bright young guys and all that, and your business plan looks good, but you've got no experience and you've got no collateral, so afraid we can't bank you. So that's when I had to go to individuals and found that angel investor that I was telling you about before. So with the banker, we failed to show this confidence factor that we had in the business and that we could actually make it work. But we were able to convince this one single angel investor in Toronto that really liked our story, and he joined us. And I just have in there my RIM story, and I won't go into a long song and dance on it, but RIM, you know, the BlackBerry guys, they called me up back in the late 1980s, and it was really just one guy. It was Mike Lazaridis. The other guy, Jim Balzilli, wasn't involved with BlackBerry at the time. And he says, well, Mike, you just sold your company, so you might have a little bit of money to put into my company. And I said, well, how much do you need? And he said, well, I only need $30,000. You know, this is Lazaridis, who's now a mega millionaire, right? He says, I need $30,000. And I said, well, I'll give you $30,000. What do you give me? He said, oh, I'll give you 15% of RIM. And I said, well, but there's nothing here. There's nothing. And he said, well, and there was nothing. They were doing consulting, right? They were doing projects for other companies. They didn't have Blackberries or pagers or smartphones or anything like that. Anyway, I kind of liked Lazaridis, and I said, okay, let's do it. I'll give you the money, give me the 15%. And I didn't see a business plan, right? Didn't even care about the business plan because I kind of liked the people because they showed he had confidence. But long story short, right about that time I moved to Vancouver. And so I called him up and I said, I promised to help you in addition to providing this little bit of cash. So remind me what you need the money for. And he says, well, I got these technicians I've got to pay. And I said, well, holy smokes, why don't you give them my 15% and get them to work for free? So he said, that's not a bad idea. I think I'll ask them. So he asks these two guys, and he said to one of them, well, how about 7 or 8% of the company and, no pay for a little while? And the guy said, I'll go ask my dad. And the dad says, son, get a real job. And like most kids, don't pay attention to the parents. He stayed there. He took his 7%. Long story short, I bumped into his wife in an art gallery in Ontario a few years ago. I said, oh, how's it going? She says, oh, well, we just donated another $100 million to the Arts Foundation. And so the moral of that story is not, don't be a stupid angel investor and not take the 15%, but you can avoid angel investors by giving your key employees some shares. So if you haven't thought about that already, and I'm sure you have, deal in some key people, make them co-owners, and of course put vesting provisions on their shares so that if you give them 7% or 5%, they don't quit without giving that back. So let's talk a little bit in the time that's left, and I'll go through this real quickly. And these slides, by the way, Angie will post them on the website. So this might be helpful to you in making your presentation in the case of new ventures. And even if it's not new ventures, this is the kind of stuff that angels want to see. It doesn't have to be a long document, but they want these questions answered. So having the answers to these questions is what it's all about. So in this round 2, which is due in early May, you're going to touch on these 9 points. And then in round 3, it's more or less the same, but in more detail. So you're going to add, not just technology development, but who, the technical team, market, you're going to go a little bit deeper, market scope and need, financial, you're going to do some more projections and some more number crunching. Am I right on those numbers of pages, Angie, or have they changed it at all? So it's not it's not like you have to write a Bible or anything like that. It's just a few solid pages with a lot of thought behind them. And so let me just run through them real quickly. And a lot of this is pretty obvious, so we won't spend a lot of time on it. It's the product, and explaining it may be a challenge. If it's something like a smartphone, well, we make a smartphone. That's simple. But if you're doing some kind of an app or some second or third level software tool, it may be a lot more difficult to explain it. If you can compare it to something else, say, well, this is exactly or almost like such and such, but it's different because we do it faster and at half the price or something like that. And what's important is, how are you going to generate your revenue from this? Are you actually selling the product? Are you selling a service, which is really what you're doing with software, right? With software, you never sell software. You always just license software or rent software. So it's getting that story right that's very important. Question number 2. A lot of people think that this is really important to investors. And I have to tell you, it's not as important as people generally make it out to be. Sure, it's great to have a patent or have something that you can patent, but investors, especially angel investors, know that it's very difficult for you to defend a patent. If someone steals your idea or copies it, it's going to cost you hundreds of thousands of dollars to defend that patent. It costs at least $10,000 to get one in the first place, and that's $10,000 in each country, because patents go country by country. So it can cost you $100,000. The General Fusion Company, for example, that I mentioned before, they're probably already in, probably over $1 million has already gone into patents. But for you guys, I wouldn't worry about it a lot at this stage. However, if you have something that is patentable, talk to a patent attorney, because there is this thing called a provisional patent. You'll learn a lot more about this in a subsequent seminar, but a provisional patent gives you kind of a 1-year lead time at which gives you kind of a priority filing. So that's something to keep in mind. It means you don't have to spend a lot of money right up front and gives you a year to work on your idea. Rule of thumb is, if you've got something that's patentable, patent it and talk to a patent attorney. But if you've got something that isn't patentable, don't worry about it. It's not going to make your business case less attractive. Now, some investors put a lot of value on this. Others put very little value on it. So it's sort of an investor preference thing. But talk about it. You know, mention your IP, whether it's something that you're not going to disclose, if it's a secret formula, secret recipe, or something like that. You know, again, the vegan cheese company that I mentioned, in their case, they've probably got something that could be patentable, but they didn't want to patent it because they don't want people to copy it. So, and they don't want to fight legal battles. So they just kept it a secret, just like the Coca-Cola company did with its Coke formula. Again, feel free, you know, anytime you want to stop and raise your hand and ask a question, just shout out. Technology development, you know, what's your stage of development? What's your idea? Do you have a prototype? Is there sort of a pre-production beta model, or are you actually production ready? Production ready is certainly music to investors' ears. If you have just an idea, that might be good, but you know, investors look at ideas as a dime a dozen. So keep that in mind. Entrepreneurs often ask me, well, you know, should I tell people what my idea is? They may go off and steal it. And you know, frankly, that hardly ever happens. I've never seen that happen. First of all, most angel investors don't want to steal your idea because they don't want to be you. They are them. And they want to back people like you, right? So they don't want to get back in business. They want to have fun and do lots of deals. And, you know, the exception to that is there are angels that do like to start new companies and run with them. And you might be lucky enough to get one of them as your CEO. But they're not going to steal your idea. They're not going to take your idea and develop it from scratch. So I wouldn't worry about that too much. And if you're worried about, if you do have something that you think is sensitive and you don't want to, you know, broadcast that at an angel meeting or at an open forum, talk around it. Like talk about what it will do, like Ralph was teaching you, you know, what the benefits are and so on. You don't have to give out the algorithm, and you don't have to give out the schematic diagram or whatever to angels, at least not in the early going. The fourth question is, you know, the status of your business plan. You know, just where are you? And this is for round 2. Of course, for round 3, it has to be more fully developed. The market, very important. This is number 1. Again, I'm echoing Ralph's comments here. Market, very, very important. You know, who's going to buy it? Who is your audience? And why are they going to buy it? And how are you going to, you know, what's the potential? How many of these can you sell? There's a real challenge in trying to figure out your total market available. And I want to caution you, never, ever, ever, ever say to investors, well, we are in the, just heard in the Globe and Mail this morning, the clean tech market in Canada is something around 10 point something billion dollars. So never say that we're in the clean tech market and we're going to get 1% of that market with our clean water treatment facility. Never ever say that, because investors will tune out immediately because it's a totally meaningless statement. Now, entrepreneurs like to say that because they want the investor to think that this is a huge market. Hey, we're in a 10 billion market, the sky's the limit, right? But what I want to hear and what investors want to hear is what your market niche is. And how are you going to dominate your niche? How are you going to define your niche so that you own it? That's what Steve Jobs did with every single product that he came out with. Even though those products were not particularly of the patentable types of products. He came out with products that already had been patented and created. He just did something to them that made them different. And he defined his market so that he got 90% or more of each of those markets. That's your job. That's your task, if you can do that. So, instead of saying you're going after 1% of the clean tech global or Canadian clean tech market, say you're going after the wastewater treatment of a particular capacity, of a particular size, of a particular price range, and that market is maybe $100 million market, but no one else is in there, so you can get dominance in that market. That's what you want to say. Oh, and there, Regis McKenna, he worked with the Apple guys to really perfect this. So this is available, you can Google that. It's available from the Harvard Business School. I think you have to pay for it, but it's not expensive, a couple of dollars, and because they've got it, protected. But it's called Marketing is Everything. It's a relatively old article, but it's still 100% valid, and I would certainly encourage you to take a look at that. Question 6, distribution. It's great to have something, but how are you going to get it on the shelves or wherever people are going to buy it? Is it going to go through the internet? Is it going to go through middlemen? How are you going to get it out to the point of sale where people are actually going to buy it? And there may be several channels. You may use distributors, agents, the internet. You may have your own shops or outlets. Next most important, I would think, to marketing is competition. Business is all about competition. If there were no competition, life would be easy. We'd all be doing well. Take a look at the Soviet Union, where they had the, in the previous decades, where they had a very closed economy and there wasn't much competition. They produced products like the Lada, the famous Lada car. That was the only thing available. There was no competition. That was your only choice. It'd be great to be the owner of Lada, like the Soviet Union was, but there was no competition, so no threats. But here in North America, and certainly in free enterprise societies, we have competition. And I can bet you, right now, I'll bet every one of you that right at this moment, there's an entrepreneurial group somewhere in this world that is working on exactly the same thing that you're working on. There's probably several. It always amazes me. I go to one of our angel meetings here in Vancouver. I hear 10 pitches. Then I go to Australia and I listen to 10 pitches and I hear the same 10 pitches. Then I go to Kenya and I hear the same 10 there. It never fails. So be careful. Right now, somebody's stealing your idea. The team. This is very important. And this comes down to execution, right? If you think you can do this alone by yourself, you're never going to get any investors. Because to build a company just by definition means a company of, you're in company, you're in good company, hopefully good qualified company that can really address the areas that are so important to building a company. You've got finance, marketing, operations, logistics, accounting, bookkeeping, janitorial services, clerical services. You've got everything, right? A company is a whole bunch of things that all have to be coordinated and synchronized and working together. And one of the most important things for you when you as the entrepreneur are making a pitch is to not be afraid to tell the investors what your weaknesses are. Don't lie about your weaknesses. If you say, look, I'm a really good technical guy, but I'm a little bit weak on finance. However, I've got Jim Pratt over here as my CFO, part-time, helping me out. That's okay, right? Because the investor then realizes that you know what your shortcomings are, and at the same time, you're dealing with those by bringing people on your team that can fill all of those important roles in a company. Financial. It all comes down to numbers in the end. It all comes down to how profitable is this business going to be, and it's these numbers that buyers are going to look at, right? So that's why these projections are important. It's important for you to know how much cash you're going to need, so you have to run all of these numbers. And it's really important for your ultimate buyers and, of course, your investors initially to know just how big and profitable this is going to be. And on that note, I just want to give you a little example here. And this template, by the way, is on my website if you want to play around with it. So I did something very simple here to kind of illustrate the concept. And I'll just walk through this quickly. So at the top, you see what's typically a profit and loss statement. You see gross revenue, cost of goods sold. That's what it costs you to make the stuff you're selling. So you've got your gross margin. You've got your expenses, your salaries, salespeople, R&D, general, and admin. So you've got your total expenses. And then you see your profit. And what this says that in month 3, you're starting to make a little bit of money, $2,000. And in the whole year, you're going to make $300,000, $293, on $2.16 million of revenue. Now, if I see this as an angel, that's pretty good. That's a good deal. I like that. That's something I would certainly be keen to invest in. But now the question is, how much money do you need? So this is where you now have to do a month-by-month detailed cash flow, because you're buying stuff from suppliers. They may give you credit, so you don't have to pay till a month later. Your telephone bill, you've got credit. You don't have to pay Rogers till a month or two after you use the service. Rent, you have to pay. Your employees, well, maybe you can delay them a bit. Maybe you give them shares like the RIM guys did, and so on. So you have to then start with your cash balances. And the easy way to look at this is what's in your bank account. So typically you start off with 0 in your bank account, and then you figure out, well, in the first month there you can see that you're spending $7,000. That $7,000 has got to come from somewhere, and it's got to go in your bank account, because your banker, like mine, won't let you run into a deficit. So anyway, you run this through, and I've just shortened this up, and in month number 7, in this case, it gets the worst. And it says that you're going to be in the hole by $106,000, okay? Now, so you might say, okay, we need $106,000. So here, I've modified my assumptions. And I've said, well, suppose that we have to order our supplies earlier because we're having delivery problems. So we're going to get stuff 3 months, not 1 month before. So we're going to have to buy a lot more inventory to make our products. And let's suppose our customers are slow to pay us. We're giving them credit because we're selling to governments and universities and so on. So we're not asking them to pay by credit card. We're giving them credit. But they're not paying in a month like we thought. They're paying in 2 months. So I'm going to run these numbers through again. And this time, the worst month is in month 10. That's when it gets to its low point before it starts to get better. And this says I need almost $750,000, right? So which is the right number? Somewhere between 100 and 750,000 is what it's going to take to achieve those numbers at the top, depending on how good a management team we have and how well we can deploy the inventory and process the inventory and order it and manage it and all those things that managers do, right? So this is why this cash flow exercise is so important, because a good investor in doing the due diligence is going to ask the question, is going to put it to you, what if your assumptions are wrong? How much are you going to need? Okay, Angie's giving me the evil eye, so I'm going to wrap up real quickly. Why do deals get funded? Well, it's because people behind them are good people. They're credible. They understand what they're doing, especially in their market they're in. They're realistic. You're aware of what you don't know. You know how to use experts. You have a good team. You're in control. Remember, passion, leadership, contingency planning, but mainly because the investor's going to like you. It's like a marriage, as I said earlier. It's whether the investor warms up to you, because you're going to build a relationship. Don't expect to get angel investors in and kiss them goodbye. You're going to hear from them every month. You're going to contact them every month. When you need help or more money, you're going to call them. And if you've been out of touch with them and you call them because you need more money, they're not going to be too happy. But if you've been open with them and communicative, they're going to be there to help you when you need that kind of help. And a few final tips. Remember the 1% market. Never say that. Don't compromise yourself. Don't bullshit with BS bingo. Show leadership. Never procrastinate. And that's that. Thank you very much.
Thank you very much, Mike. Mike is usually very generous with his time, so he'll be around to answer questions afterwards. The videos will be posted in a few days at our website, newventuresbc.com, and you can get slides and past seminars, everything there. So quickly, we got a whole bunch of stuff coming up. Tomorrow, if you're in the competition, we have a round 2 strategy session with a past winner. That's tomorrow afternoon. Monday, we're doing business model canvas, also part of your submission. And then next Wednesday, we are talking business models and pricing. And that's not here this time. We're now starting our tour of SFU campuses. So we're going to the Center for Dialogue, which is just basically diagonal from here. And that's then that'll be it. And then there's more and more after that. So go to our website, newventuresbc.com, and you can see everything. So otherwise, thanks for coming. Good night.